In my opinion, the single most reliable dividend stock that you can buy is none other than Verizon, because if we pull up their dividend yield history, looking at the chart, it shows Verizon's lowest dividend yield over the past 13 years has been 3.9%, with the median yield over that time being 4.5%. And I think this perfectly demonstrates just how impressive Verizon's dividend history has been, because even dividend kings like Ford and Coca-Cola can't say that they've steadily maintained a dividend that high for that long. And shares of Verizon are trading at 40.68, and they are up around 11% this year. Zooming out on the chart, we can see that there is almost a complete lack of volatility in this stock, unlike so many others that we've seen that have had extreme bull and bear cycles over the years. And that stability is really what we look for in a great dividend stock. For my December 2026 price projection, their current earnings are $2.67 a share, but that is expected to increase up to 81% to $4.91 a share by 2027. And their TTM price to earnings is about 15.2, but the average tech sector price to earnings is about 35. However, I'm going to use Verizon's historical average, which is close to 11.5. And if we multiply the projected earnings per share of $4.91 by that 11.5, then that would give us a share price of $56.47, which is a 39% upside and is really good, especially for a stock that offers such a large and stable dividend. It looks like other analysts are pretty bullish as well, with the average one-year analyst price forecast being 45.08, which is around 11% higher than where it trades today, with a high estimate of 52 and a low of 40. In terms of fundamentals, Verizon has beat 3 of its last 4 earnings calls. They have a shareholder equity of about $94 billion and a total debt of $175, and that makes their debt to equity pretty high at $186. And it looks like they have about $2.4 billion worth of cash on hand, and that makes their fundamentals pretty solid, but there is a lot of debt. They do, of course, offer a massive 6.54% dividend yield, and it looks like their revenue and net income have remained incredibly consistent lately. Again, the only real red flag I see is, of course, their massive debt to equity. And taking a look at the chart, it looks like they have used a lot of long-term debt over the years to finance a lot of their growth. And that's going to be pretty costly once they start to refinance that debt. And it's going to bring up their interest payments. But they're going to really need to meet their earnings growth expectations in order to soften that hit from those interest payments. And with an annual free cash flow of $18 billion, though, I seriously doubt that this mountain of debt's going to be any issue, because that is a serious amount of cash flow, free cash flow at that. That's after they pay their debts. And even given that, though, I would like to see them start paying their long-term debt down going forward, because 186% is just too much. It's going into overload territory. So that given, I like the earnings projections, and I feel very confident in Verizon's ability to pay down its debts while at the same time offering that high dividend going forward. So for this reason, I have to rate Verizon a buy, because even though their valuation might be slightly high, and even though they do have a lot of debt, their valuation historically isn't terribly high compared to their average. And again, those earnings are going to make up for all their debt payments that are coming up for refinance. So, and especially, if their earnings are expected to increase by around 81% in the next 2 years, I mean, that definitely makes up for any manner of sins. So that's all I have for you today on Verizon stock. Please drop a like. Let me know which stocks you'd like me to cover next, and I will see you next video.